All right, well, tomorrow's inflation data and Wednesday's Fed decision will steal investor focus this week. A strong CPI number for May will reinforce the idea that the Fed has a lot more work to do in cooling this still resilient economy. As ever, the core figure is in focus. Headline inflation has gradually edged down, but the reading excluding food and gas has been sticky and is likely to stay well above the Fed's comfort zone. Investor bets are in for the central bank to pause hikes for the first time in 18 months, but call it a hawkish pause. Let's bring in Richard du Chazal, William Blair Macro Analyst, for more. Thank you so much for joining us this morning. So, as we're looking at what the markets are expecting versus what the Fed may do, are we still looking at a pause and a pivot versus a pause and a hike, more of a skip in this situation?
Yeah, I think that previously, sort of maybe 2 weeks ago, it was kind of looking like a pause, and then the Fed maybe just stop there and no more rate hikes going forward. I think over the last few weeks, we've seen stronger payroll data, inflation a little bit stickier on some of the different measures. We're now sort of changed that pause to more of a skip. So the Fed this week on Wednesday, it looks like it'll probably pause or skip. And then the probability of another rate increase taking place in July has actually picked up. So if you look at, market-based probabilities, there's about a 25% probability that the Fed raises rates this week. But if you look out to July, that's increased to about 53%.
So then as you look at some of this other macro data that we're going to see this week, we've got CPI, PPI, initial jobless claims, retail sales, Michigan consumer sentiment. What sort of position does this put the Fed in when you have this, what could be considered a make or break CPI print coming up?
Yeah, a lot of data this week. I think, on the goods side, if we look at what we're expecting for the CPI, I think we're going to start to see some better numbers this month and in June. The comparisons compared to last year are much easier. So if you remember back last year, following the invasion of the Ukraine, inflation peaked at 6.9%. Back in June, so that makes it an easy comparison for May and then for June coming next month. I think what we can see for this month is, because as you mentioned, energy prices have been coming down, food prices have been coming down, so we're looking at a more moderate headline number of inflation. So in the previous month we had a 0.4% gain. I think this month it'll be 0.1%, and then we'll see that headline number coming down quite significantly. On the core, things are a little bit stickier. So Powell likes to look at his three inflation buckets. So he likes to look at durable goods prices, he likes to look at shelter prices, and he likes to look at the services component ex shelter. And I think what we've seen there is higher rates have been moving through the economy and having the sort of impact that you would expect. So we've seen durable goods prices come down quite significantly. What we haven't yet seen is much give or much decline on the services less shelter component and the shelter component. But again, I think on both of those, I think we should start to see some disinflationary trends coming through as well. So for example, on the shelter component, we know some of the more forward-looking indicators like the Zillow rent price index or the Fannie Mae rent price index. Those tend to lead the Bureau of Labor Statistics, the CPI's rent component, by about 8 to 14 months. And those are coming down quite sharply, which should start to feed into the CPI shelter component in the coming months. Similarly, if we look at the services component, excluding that shelter component, if we think that that is largely based on wages, say, for example, CPI for haircuts, wages seem to be moderating as well. We had a conference last week where we had a lot of companies and staffing related companies, and the consensus amongst a lot of these companies was really that 2022 had been a catch-up year for wages, and now that's kind of done, and pressure there is starting to moderate. So I think similarly, services wages component, it's a lagging component, but I think we should start to see some good news coming through there as well.
So then for investors who are trying to look for some direction here in this pausing phase for the Fed then, I mean, you have the VIX ticking up today, but you're still seeing tech ahead today, and then also taking a look at what we're seeing with the action in the bond market. What do you think is the best indicator then of what's going to happen to the economy next?
Well, typically the bond market is going to be the most sensitive to macroeconomic data. I mean, the equity market is a good indicator, but it's not quite as sensitive to the pure macro data as the bond market is. I think we'll probably see a little bit of volatility coming through into the second half of this year. We have a lot of sort of conflicting forces. The Treasury has to rebuild its Treasury general account, its savings account that it held at the Fed, which was run down during the debt ceiling. So most of this year, it has to rebuild that. That's going to put a little bit further pressure on yields to stay a little bit higher than perhaps they otherwise might in the face of what we think is going to be decelerating economic growth moving forward.
I do appreciate you breaking all that down for us. Richard Chazal, William Blair Macro Analyst, thank you for your time this morning.
Thanks for having me.